Good morning. This meeting of the board is a hybrid physical virtual meeting. I would like to welcome those in the boardroom with me today. While keeping your microphone muted, please join me in the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America, to the republic for which stands one nation under God, indivisible, with liberty and justice. Before I turn it back over to Ashley, I'd like to take a moment to extend a warm welcome to Seema Mahaney, our new General Counsel. Welcome. Seema brings more than 2 decades of federal legal service, including 15 years with USDA Rural Development and most recently as Senior Counsel at USAID. She's a graduate of Vanderbilt Law School and Washington University in St. Louis. She brings a deep understanding of agricultural policy, legal compliance, and federal financial assistance. Her experience spans complex legal framework, interagency collaboration, and international food security. All of those which serve our agency very well. We're excited to have you on board and welcome to FCA. Also, I want to thank Ward Griffin for his time serving as the acting general counsel and really over 2 months. Ward, they moved you on me. See ya. Thank you. During the period, he felt rapid developments he's had to deal, and the whole general counsel team and many here have dealt with over 250 executive orders, presidential memoranda, fact sheets, FOIA requests, and all the other regular stuff we have to do as an agency. He provided steady leadership and expert counsel. Your tireless dedication and readiness to serve is deeply appreciated, and we thank you and continued service for this agency. Thank you both. So at this time, I'm going to ask the Secretary of the Board to address a few technical and protocol items.
We have a quorum. The full board is present for this meeting, Chairman Hall and Board Member Smith. Please ensure that you have silenced any mobile devices you have with you. The virtual portion of this hybrid meeting is on Cisco WebEx. We have 2 OIT staff, Ben Rana and Victor Amaya, monitoring and managing the meeting. They will be locking this meeting and no new connections will be allowed. OIT will be advancing the slides, so you will hear presenters say, "Next slide." If you lose connectivity in this meeting, please contact Victor Amaya. Lastly, this meeting is being recorded. The video recording of the open portion of this meeting will be posted for public viewing for a limited period of time. Chairman Hall, that concludes the technical and protocol items. We're ready to continue when you are.
Secretary will read an opening statement on the government in the Sunshine Act.
This is an open Farm Credit Administration board meeting under the Government in the Sunshine Act. If anyone raises a subject that may be discussed in closed session as permitted by the Government in the Sunshine Act, Chairman Hall will entertain a motion to close the meeting.
We will now review the published meeting agenda. Is there a motion to adopt the agenda as published?
There is. I move to adopt the agenda as published.
I second the motion. Motion has been made and seconded. Is there any further discussion? If not, the Secretary will record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. Next, we will consider whether any portions of the meeting should be closed to the public.
The agenda does include items that we should properly discuss in closed session. I move that we close the meeting at that point.
Second the motion. The motion's been made and seconded. Is there any further discussion? If not, the Secretary will record the vote on this motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. Please turn to tab 1, and the next item on the agenda is approval of the minutes as presented behind tab 1.
Mr. Chairman, I move to approve the minutes for the April 10th, 2025 regular board meeting as presented.
I second the motion. The motion's been seconded. Is there any further discussion on the matter? If not, the Secretary will record the vote on the motion.
Mr. Smith?
Aye.
Chairman Hall?
Aye. Motion carries. Please turn to tab 2, and I'm going to ask Dave Lewandowski to present an update on the Farm Credit System funding conditions. This is an information item.
Good morning, Chairman Hall. Good morning, Board Member Smith. Feeling a little nostalgic today. June 1987 was when I joined FCA. Just to go back in time a little bit, Black Monday, October 1987 was Black Monday. If some of those that are in the room might recall that. Not a great day. Hopefully we'll see that. Movie Wall Street, December 1987 as well. So this morning, Gordon Gekko, just trying to channel a little bit with that. I broke out the braces and everything and have that going on. Remember, Gordon's number one thing was greed is good, but I can add to that a little bit. Greed is good, but much like speed, too much of it kills. So we have that going on. Again, broke out the braces and the hair gel. Oh, and if you're trying to get into some of your older clothes that are on the hanger that somehow shrank while there, just prep a house in a week for a sale. You'll cut weight like a wrestler for a match. That, and you have to have the right motivator. Okay. So we'll go on with the more serious stuff. While I'm here today with the honor of presenting for the FCA board, as well as the many times over the past roughly 30 years. That is 9 counting Chairman Hall. So we have a cat, so I know it's time to go because I hit number 9. Basically, just to review, in the Farm Credit Act 1971 as amended, Section 4.2 says power to borrow, issuance of notes, bonds, debentures, and other obligations. All these, if you start with B, it says issue its own notes, bonds, debentures, or other similar obligations fully collateralized as provided in Section 4.3 by the notes, mortgages, and security instruments it holds in the performance of its functions under this act, in such sums, maturities, rates of interest, and terms and conditions of each issue as it may be determined with the overall approval of FCA, Farm Credit Administration. There's a C and D as well, but again, the Farm Credit Administration is the overriding approval for the issuance of debt. A very wieldy sword to have. We have other people and other regulators that are very jealous of that particular statute that we have at our discretion. So again, part of this funding approvals is our office, which I'm about to give you some updates on what's going on with those funding conditions. Again, with the approvals of the Farm Credit Administration, pivotal for the issuance of debt. Next slide, please. Again, the update. Next slide, please. Again, just some recent headlines just for your to peruse here. Again, we did an update. We did a funding update in January. Obviously, things have changed markedly since that time period in a number of ways. We have a different administration in the White House. We also have had as I call it, the tariff tango, which is just broke as of April 4th was the Liberation Day in the administration's words. And there's some recent headlines that kind of denote the last 4 months since we've been here previously. Next slide, please. Again, another slide that denotes what's been going on in the recent financial press relative to, again, all the different aspects of the tariffs that are being put in play or being negotiated. Next slide, please. And again, one last one, just to show the volatility in the equity markets that's been part and parcel of these negotiations and or announcements, if you will. Next slide, please. Okay, here we're going to look at the topics. It's a familiar slate, if you will. Again, global market, agency debt market, funding, corporate activity, yields and spreads. Obviously, keeping very close eye on those to see where the system is being relative to risk premiums. FCS liquidity, basically the backup for if funding weren't able to be facilitated through the normal course of debt issuance, and then potential geopolitical impacts. Next slide, please. Okay, we're going to spend a little time here. The U.S. market, obviously the Fed just announced yesterday they're on hold. Chairman Powell used the version of the word wait 22 times to underscore how the Fed isn't in a rush. So the cost of waiting to see further are fairly low, we think. So that's what we are doing, said Chairman Powell. So again, we're in basically the Fed's in a holding pattern. The markets think there will be 75 basis points maybe later in the year, but again, a lot of that's going to be dependent upon what the employment picture looks like, if the inflation, and then obviously what actually happens with tariffs. And then we go on down to the next one. Actually, the Fed's kind of the outlier to a point. The ECB, meanwhile, has cut its benchmark rate 7 times in the last year by a combined 175 basis points to 225 last month. So no longer viewing it as restrictive rate. So again, ECB they've had some issues over in the European economy for some time, so they've been making their way, and the tariffs just exacerbated those concerns. So they're down to a 2.25 last month. The Bank of England again, this is a big week. The Fed, our meeting, and then this morning across the pond, the The UK, just the Bank of England just cut theirs 25 basis points, so they're at 4.252. So again, just a few hours ago. The last one with the Bank of Japan, again, that's been a different economy for quite some time. They actually increased to 50 basis points in January, but they've held steady at their May 1st meeting. Again, May, a big meeting month. And then one of the other things is obviously China, the next part on the slide. A lot of things going on over there, some of which are very hard to discern because they can be a little close to the vest on what they'll let people know. But they announced that they would be cutting rates later this month. So again, and all of these things are a lot of it's tied to the tariff deals being negotiated, and obviously there's supposed to be a meeting going on between Secretary Bennett and the Chinese, I believe, in Switzerland this week, if I heard correctly. Next slide, please. Oh, I'm sorry, geopolitical. I'll still cover that. We have these various things with the tariffs, but then you also have the war in Ukraine is still going on. I mean, they're trying to broker a deal there. You have the Middle East, and things are trying to settle down there, but we still have the Israelis and Gaza going on. Not to mention with the U.S.'s armed forces over there, and with and Iran's negotiation over the nuclear deal. There's a number of aspects going on as far as geopolitically that could impact the global market on a moment's notice. And then just yesterday we were talking about India and Pakistan having a long-term simmering dispute over Kashmir. It looks like it flared up again. That would be a big event if that became a really hot war. Those are two large countries. Next slide, please. Just here to give a little flavor for what we see in the global yields. Again, over the course of the last more or less 2 years, we did have the events in of March of 2023 with the commercial banking sector and liquidity. But you can see there's a hierarchy of global yields here, denoted between the major economies. Again, Japan kind of sticks out because of where they are and their lagging growth for a long-term number of years. But you can also see where, generally speaking, there's a spread that stays fairly consistent between the different economies. Although China is that green line, that has come down somewhat in their 10-year yields. Next slide, please. Here we have the credit rating agency's outlook for the United States. Again, there's a linkage with the systems ratings. And as we see here, again, no change from the last time we were here, but the negative outlook for Moody's with the debt ceiling coming up and with the concerns about that may trigger Moody's with a negative outlook to actually pull the pin and go down to the next level with the other two. Last time that happened with Fitch, not that long ago, there was not really any big change in the yields, but it is something to watch, and whether that happens with the three of them all down at one rung, if you will, whether that does cause additional costs to the system due to that, because again, linkage with the United States. Next slide, please. Here, just to give a flavor for who the players are in the GSE debt issuance land, you can see the home loan banks far surpass everyone else that's involved as far as Freddie and Fannie and the system. The reason for that is that the home loan banks and through their Office of Finance, which is right up the road in Reston, they basically short fund most of their debt in discount notes, so things that are less than a year, and even so more like overnight, if it may be a little bit longer. So they turn over their portfolio a lot more than those other parties do. Specifically, the system makes longer term loans. The home loan banks again cater to the commercial banking sector, and there is more of a liquidity play there, where they provide liquidity when banks are in the need of advances against shorter term funding. Their overall portfolio was up roughly with up to 60% of their debt would mature within a year at one point. The system, in contrast, is roughly 35%. So again, they're dependent on markets being open for that to be done. And that's the one thing with short-term funding, you are depending on the markets to be open for you to be able to refinance that debt coming due. Next slide, please. Here we just have again the hierarchy of debt outstanding for the for the different parties involved. We do have Farmer Mac and Tennessee Valley Authority on there, and just to keep a complete set. You can also see that, again, home loan, as I just talked about, they're over $1 trillion, and they have been for quite some time. Back in the 08, 09 timeframe, Freddie and Fannie were roughly commensurate with that. There used to be, so the overall debt outstanding in that market back then was, the GSE market back then was right around 3 trillion. Now it's just under 2, as you can see. One of the things to note here is the system's had a slow and steady growth pattern go with that outstanding, and I can see it being potentially this end of this year or very quickly in the next year, depending on a number of factors, where they will go over the $500 billion mark, which is at $500 billion. And my understanding from talking to both Ms. McCabe up at the Funding Corp and as well as others is that maybe bring more scrutiny to the system relative to having that $500 billion mark eclipsed. So that is just something that we'll be continuing to monitor and asking different parties about what their views are on that. Next slide, please. Here is just an encapsulation of where the different debt products are for the system. And over the course of time, you can see a pretty good growth factor there. Through the course of from the end of 21 to the current, I was able to pull something at 5.1. And the amount of increase primarily has been in the SOFR product, as you can see right there. Between the SOFR and the prime and the other floating index debt securities, they comprise, if you take the discount notes, which mature within a year, they're roughly almost 40, getting close to 50% of the, I think it's 47% of the overall debt outstanding. So again, the banks are choosing that particular form of funding because they feel it's the best value. The floating rate does expose you to obviously more increases in the future, but it also lets you benefit if there's decreases in the interest rates. As long as you match fund that, you're basically going to be walled off from any concerns there. But again, there's some flexibility there because with the uncertainty of the environment at hand, that's the way the banks have decided to structure a lot of their issuances during the course of this year, but also for quite some time. Next slide, please. Here is just a list of those banks those dealers that are part of the selling group. Basically, we have 33 there, and just again, these dealers underwrite those securities. So if they don't have an investor that they're going to just directly sell to that system issuance to, they will put that on their balance sheet. The volatility of late has caused like the callable issuances to be very somewhat harder to place because you can't hedge a callable debt structure like you can with a bullet, and obviously the floating rates are going to go with the interest rate changes. So if you want to issue a callable debt structure, which some banks like to utilize, it can cost you with your premiums a little bit more, but also the dealers may take a while to get them off their balance sheet, and they'll expose them to risk. So they may not be in much desire to have those callables sit on their balance sheet. So that makes that trade a little bit more difficult than it has this year, and with all the volatility. Next slide, please. So here, just to give a feel for where the bullet curve is for the system, and again, since we were here last in January, it just gives you an idea. We were just about approaching a normally sloped yield curve at 1.625. So again, that's generally fortuitous for financial institutions because you take it in short and you lend it out long, and you make the carry trade, make the spread difference to be profitable. Now we have, since the new administration came into play, but also the Liberation Day, you can see where we've gone into a more back to an inversion that was in place in 2024 for a long standing time before that. Indicative of potentially a slowdown in growth, concerns about a slowdown in the business environment, and then the potential for a recession. The last GDP numbers for the first quarter showed a negative. A lot of that has to do with the way it's calculated with the trade deficit that's part of it that detracts from that. But in technically speaking, two quarters of negative is technically a recession. Again, that is not necessarily always portends of a recession, but that has been a fairly consistent sign of one, that potential for one. And again, the inverted curve does have negative ramifications for financial institutions over the long term. Next slide, please. Here's again the spreads for the system's 2, 5, and 10-year securities. You can see again referencing back to that commercial banking issue with their investments that was caused by the high increases in interest rates that were trying to beat back inflation by the Fed. You can see there that the concerns over that prompted those spreads to widen quite a bit, and that you can see the end of that in April 23. Since that, we've come down quite a bit. The system's premiums have come down quite a bit, and they do most of their business in the 1 to 5 year range. So those spreads are really, they do others, but those spreads are where you're going to see what kind of premiums they're paying. And they did blip up a little bit with what went on in March and April, but they've gone back down to, so for a 5 year, you can do that over Treasury at a 5 basis point of risk premium. That's very thin. That's very favorable. And same holds true for the 2 year, and maybe even to a 4. They did blip up. The 5 year did blip up to about 10, but again, very favorable rates. 10 years is a little different story, as you can see, because there is more time for things to change over the course of that security's maturity. Next slide, please. And here, just a little more granularity on where the specific yields have been over the course of the maturity spectrum. You can kind of see where we go out to 30 years, but also from the very beginning of the 6-month curve. You can see very thin spreads out to a 5 year, and then they start to ratchet up a little bit, and to the point that again the system does most of its business where those premiums are very thin for bullets anyway. Next slide, please. Just want to review again. This is the secondary source of paying those debt securities. If the system were ever having an issue trying to access the market, then they have the backup of the days of liquidity, which each bank has its own philosophy on how much days of liquidity, other than the regulatory minimums. They all meet them very highly meet those minimums, and also the system as a whole has a very stout amount of liquidity to, in the case of needing to fund debt because they need to refinance it or meet needs of a borrower, which is part of the liquidity's purpose, to not only fund the debt that's maturing if you can't access the market, but also fund needs of those borrowers that would be in need of those funds. Next slide, please. Again, the wild cards we're talking about the last 3 months should show you what wild cards look like. We have the political agenda, we have the Federal Reserve, and they're caught between a rock and a hard place, in my opinion, between what happened with the whole transitory inflation and the fact that got up to 9%, and then now I think the Fed is if you would grant me the term, snake bit by the fact that did occur. So they're a little, I think they're very leery of reigniting that flame. And they're going to be very cautious, as I said, with Chairman Powell's remarks about cutting rates until they see some reason to do it, like the unemployment data or the jobs report, or again, the GDP may be going really farther south. That again, the Fed feels like they need to, I think, restore their credibility. That's my opinion. Global conflicts, we talked about those. Again, there's a number that we had that I didn't mention. We can talk about Taiwan and China. I mean, trade is kind of a different version of warfare. It's just it's an economic way, not a military hot war, but there are aspects of it that are very similar. And then we have the ongoing ones that we talked about, not to mention the new one with hopefully not India and Pakistan. Next slide, please. Just to summarize, overall strong demand for FCS debt, again, varies by type. I talked about the calls having a little bit of an issue just because of the variability that is in play now with the various things going on with the market, and also the political agendas and the tariffs. There can be those callables can be a little bit harder to place, but very strong demand for the shorter term stuff. The SOFR that we showed, that basically has money markets. There's almost $7 trillion in the money markets, and that amount of money that has to find a home. So one of the places it finds a home with a limited amount of exposure is that the money market funds are mandated to do is something below 2 years, and that the price is basically indexed, so there's not a price problem there as far as losing money, and that is what the SOFR that they've been issuing entails. So the money market funds have been strong demand for that type of SOFR product, both at the system but also at the home loans. So it's definitely been something that the banks have utilized. Bullets do come in with fairly thin spreads, but again, there's been one of the reasons is because not many people are issuing bullets. They don't want to get caught if rates go down with paying more than they have to. So that's another reason that bullets have kind of been fairly underutilized of late. Talked about the inverted yield curve, or the re-inversion, if you will. You see where the normally sloping yield curve has gone back to the belly of the curve, going below the short-term costs. Again, a number of factors involved in that, but that portends for a potential economic slowdown if history serves, and also not a favorable environment long-term for financial institutions because of the way they make their money. Favorable risk premiums. Again, we talked about how thin those spreads are on most products that the system uses, SOFR included. So again, the system viewed very favorably, at least in terms of the risk that the investors are demanding on top of Treasury. The strong secondary liquidity, we talked about that, what it does and how it benefits the system to have that on hand, both from in an earnings perspective, but mainly in the idea that investors can count on something else besides the markets to pay their debts as they come due, if they had to. And the wild cards, again, between the tariff tango, if you will, and the conflicts globally, and what happens with the negotiation with the two biggest economies, U.S. and China, yet to be determined. That's all I had at this point, sir.
Mr. Smith, any questions on the material presented?
Well, I'll start out by thanking David for his 38 years of service. We're really going to miss you, David, and I think David embodies the spirit here at FCA. You have a background in ag, so you appreciate agricultural decisions we make here every day. But not only that, I can remember the first summer picnic. We pulled up and David opened his trunk and I helped him pull out the volleyballs and the footballs and the horseshoe set and everything. The camaraderie and the spirit that you've embodied here at FCA is truly a good example for all of us, and showing that it's okay to have fun too, along with work, and even a sense of humor occasionally, if you get his if you get his jokes.
Hey, you have to ask my wife about that. I don't know if she thinks that's always good.
But beyond the commendation, I'm really going to miss your sense of history. And going back to 1987, you and I both remember, the key to the success of the farm credit system is those razor-thin margins over treasuries, but that wasn't always the case.
No, sir.
And late 80s, you actually had to pay a premium to be a farm credit borrower. I can remember pricing loans, operating loans of 17, 18% with a local PCA, where the local bank was 14 to 15%. So given that is so critical, what, in your opinion, is, knowing the system as you know it today, what is the biggest threat to keeping those margins at a favorable rate right now?
Well, again, if you're going to use Treasury as your baseline, right? Obviously, they have no control over what the general government's doing in their debt structures and how they're handling their fiscal responsibilities, if you will. The biggest thing is to be financially, have the financial wherewithal to have, in the terms of the street, a good money bond, right? That you're going to get the money back. And now the thing is with Treasury, again, gold standard in theory, that where you're pricing above that is kind of the reflection of how certain people are of getting that money back. Now they want to diversify. They'll maybe take a farm credit bond instead of a Treasury for a couple different factors. One of which is there generally is that, little bit of premium to juice up their yields. But the idea that they need to have confidence that you're a good money bond. So the fortitude of the system to be able, to have the capital structure it has, the underwriting standards it has, all those things. And then, there is, admittedly, there's the government support programs that do kind of underpin some of the agricultural economy. So that does, I'm not going to say that's not part of it. I think at one time, there was talk about some of the system institutions may look at not being a GSE. And the research I saw that would cost about 50 basis points for them to shake off that, that headline or that designation. So again, there's a cost structure. Obviously there's people out there that aren't GSEs that lend money, but part of the idea is, again, I view it as a national security part of the system, and if you can't feed your people, you're probably going to have a problem. Generally people don't like going hungry. It can cause you to have, major issues. Just ask some countries around the world. So I think the idea that keep your financial house in order. Again, lend to the people you should lend to. Again, you got to take some risk, but be cognizant of, you're supposed to be here tomorrow too, not just today.
Dave, just let me add my appreciation for your leadership working with the funding corps. So much of the funding activity is going behind the scenes. We just don't see it until there's a problem, but there's never been a problem. There's no hiccups. And that's that steady leadership that I think you've provided. We really appreciate that and wish you the best in retirement.
Thank you. If I could just ask one more thing, I wrote this.
Whatever you want.
I wrote this the other day. It's called if the funds don't flow, then the tractors don't roll, and the seeds don't get sown, the crops don't get grown, stockpiles get low, then food's worth more than gold. That's because you can't eat gold. God bless all the farmers and ranchers and lands they tend and call home on behalf of all the rest of us for which we depend.
Very good.
We ought to put that on a plaque.
So if there are no further questions, Dave, again, thank you for not just the presentation, but your years of service to FCA. Thank you. At this point, we're going to turn to the closed session tab. I would like to thank the members of the public for attending the meeting. The next agenda item is a topic for closed session. Because the topic is exempt under the Government in the Sunshine Act and the board has voted to do so, I will ask members of the public and staff who are not attending the closed session to please leave the meeting.